So two questions which Franklin's comments raised that I want to turn back to Sheila Bair and Richard Herring on. One is the broad question of how do we get a debate? And secondly, the more narrow question, which if I heard correctly, Franklin Allen proposing, is that we ought to be actually raising interest rates now, not sooner than later, but now. And this was a conversation we were having a bit at lunch, that perhaps actually there is the very low Fed's rates are hindering economic activity because of uncertainty. Sheila Bair, do you have comments on this, Richard?
Well,
okay,
so I hardly know where to start. Look, we do need a public debate on this. I've spoken up. Tom Honnigan and others have spoken up. You're right. I think there's always an effort to try to marginalize people who want to dissent, and I think that's unfortunate because we need a healthy debate on this. And listen, I would support it if I could see real job growth, if I could see real economic activity, real wages going up, but we're not seeing any of that. We've got an economy that's, to the extent it has juice, it's with financial asset speculation. It's not the jobs are being created or lower paying jobs. It's not translating into the real economy. And Susan, I agree. I think it hinders lending in a way because you've got this massive uncertainty about when interest rates are going to go up, how fast they go up. You don't want to lend long because you don't want to get caught in that. The regulators actually are sitting on banks not to lend long. So you lend short, you're conservative, you don't know what the impact on the economy is going to be. Is it easier just to take your cheap deposits and let them sit in excess reserves at 25 basis points, or invest in treasuries or GSEs, and that's low yielding, but still, you can make a bit of a margin and recapitalize, and what do? So you get either that dynamic or you get the opposite one, which is what we saw prior to the crisis. It says, you start, and you see this more not with so much with banks, but with pension funds and insurance companies that are searching for yield, and they traditionally are conservative investors, but they can't get the return that they need now by investing in traditionally safe securities. So they're doing things they shouldn't. They're investing in hedge funds. They're buying junk debt. And you're seeing, because you have fairly massive amounts of investments trying to chase yield, they are underpricing risk. So the market risk, you're right, is the biggest one, but we also have a credit risk problem because junky companies and uncredit-worthy borrowers can get credit now because people are looking for yield, and that increases. You have another dip in the economy, you're going to have, or even without it, you could have some serious defaults that were not appropriately priced into the market just because people are so desperate for yields. So I think the risks here are tremendous. I wish they start gradually, ratchet down those bond purchases, then start gradually increasing the Fed funds rate. I'm agnostic on whether they sell their securities. Maybe it'd be best just to keep those on balance sheet at this point. But get ahead of this because if inflation raises its ugly head, and at some point it will, this time it's not different. Eventually this is going to have an impact. If they let it get ahead of them, then they're going to find themselves in a situation where they're going to have to raise interest rates more quickly. Which could have a bad impact on the economy, and it's also going to result in very substantial market declines in market value of low-yielding assets that are accumulating on financial institution balance sheets. So again, if we were getting some real economic growth from it, it may be worth the risk, but we are not. It made sense to do it in 2008 and 2009. It hasn't made sense to do it since. And I wish there was more discussion of this and less marginalization of people who try to raise concerns about it.
This is going to be very boring and basically agreeing with everybody, but I think, again, it's interesting to see how this notion of a very unorthodox monetary policy has captured the debate internationally. It's not just the U.S. It's the UK, it's getting to be the EU, and it's certainly Japan.
Now it's Australia.
And it's Australia. And there is no evidence that it's working. It's interesting to look at Ben Bernanke's last press conference where he was pressed by a couple of fairly shrewd reporters to say, well, how do you know it's working? And he said, well, we know it has to be in the right direction. He had no quantitative evidence. Their models say it should work, therefore it is, but somehow it doesn't show up in the data. We know what's happening with the money. It's going into excess reserves because banks can actually make more holding those excess reserves, at the Fed than they can by lending them out. And it's risky to lend things out because who knows how long the Fed is going to be out this. And I think it's worth emphasizing what a massive redistribution we're seeing from savers to borrowers, and often borrowers who don't deserve special treatment. Sheila's right that we haven't seen accelerating inflation, but simply the inflation we've got means that you're getting a negative return in real terms if you hold a less risky asset. And I'm really, really concerned about a number of my friends who are facing retirement who think they just can't make it holding a normally risky portfolio. And I think you're right, are driving down credit spreads by reaching for junk bonds and stuff they ordinarily wouldn't touch. So I'm very concerned that we're seeing in this current monetary policy the seeds of the next bubble. And there's a sense in which you could argue the current stock market is an example of it, because there's not much holding it up except for very, very low interest rates.